Professor King, thank you so much for being with us today. I know that you are away. Just wanted to ask you, in terms of the Mind the Gap colloquium, we know that the Good Governance Academy's colloquiums are really focused on the critical business issues in the world at the time and providing thought leadership on that. Why did you think that the gap in expectations between the auditor and accountant and the public in terms of Mind the Gap was an important and critical business issue?
Well, you and I are directors of a company, and let's assume you and I are trustworthy persons, and we have a generally good reputation, and therefore people should accept what we report on. But over the decades, it's been customary to have a third-party assurance that, notwithstanding your and my credibility, the third independent party would assure the reader, the user, that what you and I have put there as something that's happened during a reporting period is fairly stated. And in order to achieve this, there are standards by which you and I report. So let's just deal with why I wrote the book, which was The Auditor Quo Vadis. I became concerned at least 15 years ago by the fact that only about 30% of the market cap of companies could be found in the financial statements, and the rest was in the so-called non-financial area, then intangible assets, now sustainability issues, now ESG issues. And the public and the markets realized that companies were using natural assets faster than nature was regenerating them, and population was growing, so the demand for product was increasing. And that equation is got a frightening outcome, because it makes the earth not sustainable. And yet the auditor was auditing financial statements which were not dealing with 70% of value of a company. It also struck me that the accountant who has to become a registered auditor was actually having a business which was declining, that he or she or it, organization, registered auditor with IRBA, our regulatory body for auditing, and yet it was only giving assurance to the user on 30% of value of the company, being the number of shares in issue times the market price. And I said that sustainability reporting and integrated reporting was becoming more and more important. And the external auditor just has to start developing standards, international standards of auditing, ISAs, to try and audit these issues. Otherwise, the external auditor is actually going out of business. This was of great concern to the auditing profession. At the same time, the auditor enters into a contract with the company to become the external auditor. And his or her job is to ensure that management has drawn the accounts and the board has approved those accounts according to the standards to which the management applied in drawing the accounts. So let's say there were the standards of the IASB, International Accounting Standards Board, and reflected from a judgmental basis. The auditor would say this is a fair presentation of the financial position of the company and in compliance with the IASB standards. So the auditor's job is to ensure that management had drawn their accounts according to standards, and that from that you could draw a conclusion that there was a fair presentation of the financial position of this organization. But no auditing of the so-called non-financial space, which was growing in importance. And we know, Carolynn, that the ESG funds are out maneuvering the capital funds, which are just based on profit. And ESG has become of great importance, so much so that the IFRS has now got its own sustainability reporting arm, the ISSB. The public, however, expected the auditor to find out if there was any misconduct in the company and to report on that. And that was never his or her function. So I've often said in canine terms, the auditor is not a bloodhound to sniff out misconduct. It mustn't be a lapdog. It must be arm's length and independent from management and the board. But it is a watchdog to make sure that management is drawn according to standards, and that you can draw the conclusion reasonably that there's a fair presentation of the financial position of the company. So this expectation gap has developed over the last 100 years between the public and the external auditor. And when something goes wrong, particularly if there's a liquidation, the liquidator of a company would sue the auditors on a basis that it had failed to comply with a certain ISA, International Standard of Auditing, or had not correctly applied the International Standard of Auditing. Now, assuming that is proven, in terms of the laws of contract, the auditor becomes liable for 100% of the loss of the company. Now, in delict, in a wrong, you and I are traveling in an uncontrolled intersection. We collide. You're doing 50 k's an hour. I'm doing 100 k's an hour. Your car is damaged. My car is damaged. The court has the power, in terms of the Apportionment of Damages Act, to apportion loss and to apportion harm. So it can say, well, you, Mervyn King, were doing 100 k's an hour, and Carolynn was only doing 50 k's an hour. So, Carolynn, you pay 50% of Mervyn King's loss, and Mervyn King, you pay 100% of her loss. In the thoroughbred breeders case, which was about 40 years ago, it went all the way up to the then Appellate Division, now called the Supreme Court of Appeal. It was one of the big four were the auditors, and they had failed to comply specifically and in detail with a certain ISA. Meanwhile, the company's loss was actually the cause, and the causal connection of the loss was that the chief operating officer had gone rogue, and he had siphoned a lot of money out of the company. The Big Six auditing firm joined him as a co-defendant and said, well, it's not only our failure to do this ISA specifically as it should be done, he is the real cause of the harm, and he should apportion blame, 80%, maybe 20% us. But we are ex post facto. He actually created the harm. So, but the Supreme Court of Appeal, a majority judgment, I must say, said This apportionment of damages only applies in delict, not in contract. I believe they were wrong. I side with the minority judgment. But the auditing profession, of course, was extremely concerned about this, because when something goes wrong, the company or the liquidator, if the company is in liquidation, will go for a defendant that's got the deepest pockets. And the auditor has the deepest pockets because he or she or it is obliged to ensure if they are sued for some failure of the audit. So they are covered. And I'm sure you've heard of cases of the big six and maybe even a smaller firm being sued for hundreds of millions of dollars sometimes. So you could actually get an audit firm going beyond the limit of its insurability and its insurance cover and actually go out of business. Now, I think that's completely wrong. So the Auditors Profession Act tried to cover this by amending the Audit Profession Act, but in my submission, they didn't go far enough. And we really still need to test it in court. They changed the Audit Profession Act to try and say that an auditor could join another defendant, but they didn't express the terms as such. And it's now a legal debate as to whether an auditor can join another wrongdoer. So the expectation gap of the public that the auditor didn't sniff out, for example, in the thoroughbred breeders case, that the chief operating officer was committing a wrong. They were liable, and they sued them for 100% of the loss. And the court upheld that. So this expectation gap has huge ramification. It's a belief out there in the public that the auditor must sniff out what is wrong. And the auditor, I call the big four the lost four, because they've got a balance sheet which they can afford to buy the generative AIs that are being developed around the world, which expedite audits, expedite certain internal audit functions. And that's why today you're getting hybrid internal audits, where you have an internal auditor but attached to one of the big six, because they can expedite the internal audit function. They've got the AIs to do it. But the other audit firms haven't got the balance sheet to buy all this new technology. And that's why I call them the lost four. And we need to make sure they're around, because we do need that external audit to add credibility to what we report. So the expectation gap is an essential business issue.
Thank you. Thanks very much.